Due to popular demand, we are doing a video on 3 potential undervalued stocks: 3M, C Limited, and Etsy. I totally forgot what it was. So we're going to look at those 3 companies, and we're going to figure out, are they undervalued? Are they not? Where do we stand on them? Guys, we're going to go through some bull and bear case on them, high-level metrics, analyst estimates. We're going to go through our 8-pillar process where it applies. And also, the most important question you're probably asking is, what price should you pay for these stocks? Now, we're going to use the stock analyzer tool from our software on the ones that we actually can use them on. Okay? So in the meantime, there are going to be things in this video for beginners all the way to advanced investors. Wherever you are on the spectrum, please listen. Please understand. It may sound confusing, and that's okay. It was confusing for me and the 200,000 people who subscribe to our channel at some point. It was confusing for Warren Buffett at some point in his life. So we're here to teach a process. We want you to learn. We want you to understand this, because the more you learn, the less you will fear. And that's the most important part about investing, is not getting emotional and fearful. 3M is a stock that I do own. That doesn't mean you should go buy it. Exactly the opposite. Don't buy something just because somebody else has it that you see on TV or YouTube or anything. Even if Warren Buffett owned it, don't buy it just because he owns it. We're here to teach a process. We want you to learn how to fish. That way, you can go apply these same ideas to your own investments. So let's check this out. Let's start with 3M, based in Minnesota. Now, 3M just settled some lawsuits.
They did.
Big dividend yield, 6.1%. That's the biggest standout here on 3M. Now, I want everybody to realize that just because a company pays a big dividend doesn't mean it's always going to be there. It's a big misnomer in investing. In fact, I can't stand it on Twitter, and people are like, I'm a dividend investor. I'm like, God, I hate that so much. You should be a stock investor. You should be investing in equities, and if they pay a dividend that they can afford.
Lucky you.
What was that?
Lucky you.
What do you mean?
If they can afford it and you pick a good company and everything, and you get your money.
Yeah.
But don't just buy it just
because of a dividend.
I hate when people do that.
Yeah, they're like, oh, it's passive income. I'm like, I don't even know what that means.
Right.
All you're doing is taking from one pocket to another pocket, because the company, when the company keeps its money there, you still have a claim on that money. Now all that's happening is you're getting taxed again, because the company already paid tax on that money before it was able to be distributed to you. It's double taxation.
Yeah.
So here, 3M's dividend is $3.3 billion, and their 5-year average free cash flow is 5.4. Guys, that's 60% of their 5-year free cash flow. So these settlements they're doing are about $1 billion a year plus more on the upcoming. That's going to eat into their cash flow. Just remember that going forward. And with such a high dividend yield, the company might sit there and say, listen, we don't need to pay 6.1. If we cut the dividend in half, it's still 3%. Mm-hmm. Especially if the stock falls further. Let's say the stock falls to $60. What's it at right now?
98.67.
Okay, so let's call it 100. The stock drops to 50. That makes this dividend yield 12.2%. If I'm them, I'm like, yeah, we're cutting that. You don't need a 12% dividend. Right? That's the thing.
Yeah.
All right. 11.2% 5-year average profit margin, negative 4.4 last year. So this immediately tells me, wait a second, what's going on here? What's going on here? Let's figure this out. So I'm going to go to the income statement. And the last 4 quarters, I'm assuming there's going to be a big write-off somewhere. Wow. SG&A expense skyrocketed. Ooh. Total operating expenses were huge. So look at this, guys. Something to understand. How did they go from this 6.9, 6.8, 7, 8.1, 17.74? All right, so we're going to look into that a little bit here. And if you have the reason why the SG&A increased, please put it in the comments below so we can reference that in the future in another video. All right. Because of that, their profit was just absolute garbage in the last year. It was actually negative $1.5 billion from pretty consistent $4 to $5 billion profit. All right, now let's go look at the cash flow here. Now will be interesting. Look at their cash flow, Mo. So their cash flow in the last year was $4.4 billion. Their net income was negative 1.47. So that was probably just some sort of write-off that just got categorized in the wrong place. Did they write off that $10 billion lawsuit? Because they just settled a $10 billion lawsuit, which can be paid out over 13 years or something, $800 million a year. So it's written off quickly because it was settled, but it takes time for that cash flow to leave. That could be it. 5-year return on invested capital, 9.5%. Nothing to write home about. But is this thing going to get beaten up? I don't know. Let's Mo, let's go over some bull and bear cases on.
So it was litigation.
It was a litigation.
Litigation. Yeah.
Yep.
Okay.
It was that litigation settlement.
Mm-hmm.
There you go.
3M is going to spin off their healthcare business.
Oh, wow.
Let's see here. I remember this. Okay. The decision to spin off our healthcare business results in 2 well-capitalized world-class companies. Okay. So what do you think about that?
Usually spin-offs are done.
They did
because go ahead.
They did $8.61 billion in sales from their healthcare products in 2021.
So companies will do a spin-off when they think value. So the idea is the parts are worth more than the whole. So if you have 4 divisions together, it's like Alibaba, what they're doing. They're probably sitting there saying, we're not getting the value for our entire company because the individual parts, if we spun them off, would be way more money. So they might think to themselves, let's go get more value for it by spinning it off. Like Kenvue and Johnson & Johnson might have been the same thing, right?
Yeah.
So that is the idea behind a spinoff. All right. And there's going to be costs associated with that.
Yeah.
Don't forget that. When's that supposed to happen, Mo?
Let's see here. Announced Tuesday, and this article was written July 26th. Oh, 2022.
Expects the the company
year
expects
end of 2022.
Okay.
Okay.
Got it. All right.
All right. Let's see here. Oh, so remember the lawsuit that they settled with the public water system.
Yeah.
So 22 states urged a South Carolina federal court to reject a $12.5 billion settlement. This is from August 1st between 3M and public water systems.
Boy.
Yeah. So things could get a little sticky there. Bull cases. It appears 3M has a dollar value of its litigation liability, which is estimated to be $1.5 billion over the next 13 years.
Okay.
So they don't have to pay the big chunk up front. That's a good thing. That'll probably happen with the earplug issue, I would assume, as well.
Yeah.
That they're going through.
So explain that a little bit. There's an earplug lawsuit for military.
So there's a military earplug lawsuit. I'm going off the top of my head here. I believe it's about 200,000+ people that used the earplugs, caused some type of ear issues. That is going through a litigation process, and this has been something that's going on for a while, and it's very intense and very lengthy.
So let's look at the what else you got on 3M. Anything else?
A couple of bear cases. 3M's beat in its most recent quarter was excluding a $10.3 billion pre-tax change.
Doesn't bother me.
Again, bear case, but short term. Every single one of 3M's business segments declined on an organic and total basis in its most recent quarter.
Ooh, that's not good.
Yeah, it's not good, but
every single division?
Every single one.
Declined on an organic. Wowza.
Yep. So,
well, that's poop. All right.
Yep.
Well, that's something that to factor in our stock analyzer tool. And that's something, by the way, that I own 3M stock, but it's something I go, wait a second, is that a new trend or is that a temporary issue? That's something to very much consider on 3M. All right, let's go look at its 8 pillars right now. Remember, guys, if you have our software, you can customize your pillars up to 12 different pillars and 4 quadrillion or more variations. But Mo, net income's down because of obvious reasons, that write-off. I'm not worried about that. Cash flow down about 900 million. Okay, that's a start of something. I don't know what's going on there. We'll figure it out. A little bit more debt than we like. Now the cash flow is down, but the debt's about 5.5 times its 5-year average free cash flow. They are buying back shares. Mo, is there any share buyback news for 3M?
Let me look that up in the 10K.
So guys, they're buying back about 6% of their shares in the last 5 years. Not bad, but look at this. Their 5-year price to free cash flow is 10. All right. Now there are issues with these lawsuits. There are a lot of issues surrounding this company, but remember, you're going to get, and I'm not telling you again what to do, but the times when things are scariest are the times to be investing in companies. Is it the scariest time for 3M right now? I don't know. Maybe, maybe not. But to me, that whole organic sales are down every single division. I'm like, oh boy, that's a problem.
Mm-hmm. There's no buyback program.
No buyback
right
program.
Nope.
Why? They're keeping all their money ready to pay off settlements.
Yeah, pay litigation fees.
All right, let's see what the analysts are saying. Okay, not much growth, but decent. Analysts are expecting the company to make $8.98 per share this year, growing to $11.47 in the next 4 or 5 years. You know, 3M is in a lot of areas. They're like an everything company. I have a hard time believing that if incomes double in the next 10 years, 20 years, that 3M's revenue won't double as well. Let's go back and look at history. What were they doing 20 years ago in revenue? $19 billion. and now they're doing 33 billion. So it didn't quite double, but I don't know if the average income doubled either. So I look at that going, okay, now they've made acquisitions along the way as well. Let's go to the cash flow
Yeah,
statement.
they're divesting a lot.
Oh, they're
now.
actually divesting too. Oh, wow. Interesting. Very, very interesting, Mo.
Yeah.
That makes me feel better. So let's look at their revenue growth potential here. Again, look at this, guys. 3%. I mean, analysts are not expecting big revenue growth numbers. Very, very small. 3%. This is nothing.
Right.
So we have to factor that into their stock analyzer tool. And that's where we get to, like, what price to pay for the stock analyzer tool. Now, guys, this is the part of the software that's used 2 million times since we started keeping track. It has been used so much because it allows you to make assumptions about the future on any stock you want and say, okay, based on those assumptions, what price should I pay? It does not factor in the balance sheet, but it sits there and says, let's look at this company and say, what is it that we want to pay for this company based, because every investment is the present value of all future cash flow. So if you have any comments on these assumptions, please put them in the comments below. Mo, one thing that does concern me, their 5-year return on invested capital, 14.3. I don't care about this 1 year because that's to do with net operating profit, which has been skewed by this write-off. And so it is still skewing down here. Same with this profit margin and revenue growth. Okay, so we have some things to worry about, right?
Yeah.
But our goal here is to sit there, guys. If you like the software, if you like the stock analyzer tool, all the 30 years of data, 10,000 companies in the palm of your hand on our app, all these tools in the palm of your hand. In our chat, everything here is available at everythingmoney.com. We're running a special, 20% off, about $1 a day. I can give you 1,000 things you probably spend $1 a day on that are absolutely useless. This will change the way you would look at money. We're trying to teach a process here. So, guys, we took our time here on 3M. The next two companies, we're going to go a little bit faster into because we just want to show you our process and how we look at companies. So let's go through our stock analyzer tool real quick on 3M. 10-year analysis, I'm going to go with 2, 4, and 6% revenue growth.
Wow.
What would you have done?
1, 2, and 3.
But 3 is, I don't think, high. So what about 2, 3.5, and 5? What was that?
I do.
Really?
Yeah.
You think 3% is high?
I mean, look what they've done for the last decade.
Yeah, but look at nominal GDP growth has been pretty subdued in the last decade. Like, I just don't, like, I look at 3M going, if the world's income, if the world's GDP just doubled tomorrow, where would 3M revenue go? My guess is it would double along with it. I don't know. Maybe I'm wrong. I could be wrong on that one.
Let's, leave it.
I'll just do that. Let's do 1.
How about 1, 3, and 5?
3 and 5. Fair enough.
All right.
Profit margin. I'm going to do 10, 12 and a half, 15.
Okay.
Free cash flow margin.
Same thing.
Let's do the same thing. It's speeding it up a little bit. That's okay. PE. I'm going to do 13, 16, 13, 15, and 17.
Okay.
Same with the price of free cash flow. And for my desired return, my margin of safety, what return do I want to get? We've already beaten up 3M a lot here. I'm going to go 10, 12, and 14. How does that sound?
That sounds good.
All right. Analyze. Boom. Low end, 69. High end, 120. Middle price of 93. It's on my watch list at 90. I'm comfortable with that. If I pay today's price and the low assumptions occur, 4.8% return. Middle price assumptions occur 11.2. High assumptions occur 17.3. That includes all dividends, guys. These numbers include all the dividends. That's the key. It's not adding on top. The same with the desired return. Right. Now let's go look at Etsy. Now Etsy, we're going to go through. Etsy is a very, very high gross margin business, 70.6%. 70.6%. But they lose money, but they're generating cash flow. So in the last year, they lost $700 million in income, but I think there's a reason for that. And their free cash flow is a positive 674. If you go to their income statement, whenever income and free cash flow are drastically different, I immediately go and check it out. And look at this. Special charge of $1.1 billion. And that takes them right to their free cash flow number of $600 million. Right? Yeah. So figure out what that 1.1 billion is. The good news is they don't have repeated special income and charges.
Right. I want to point out a couple things. 8th most downloaded app in the iOS App Store.
That shocks me.
Shocks me. users of 96 million now, up from 46 million in 2019.
Okay.
So just a couple high-level things.
I don't like this, Mo. Revenue growth was going up pretty fast. 83 million, 400 million, and then it's like pretty much stabled off here.
Yeah, so I wonder that jump that happened in
Was COVID.
Was COVID, and then I do like to see that they're still growing rather than shrinking. But I think that's why that looks like
look
it's
at shares
slowing.
outstanding. They keep diluting, Mo.
Do I even want to look?
They keep diluting.
Holy crap.
Guys, every time they dilute, as you have the shares, you're getting less and less of the company. They're giving you other investors. They're diluting you. A lot of investors won't even buy a company unless shares are down over the last 10 years. And their shares are up 50%, 40, 60% in the last 10 years.
That's bad.
That is really bad. That is really, really bad. Let's see what analyst estimates are. Let's see what analysts are saying. Oh, wow. Look at this, Mo. Big growth in EPS. Expecting to make $247 a share here, $773 a share here.
Wow.
What's the stock price right now?
It is 73 bucks.
So about 9 times December 2027 earnings. Revenue growth numbers, way bigger. They're seeing big jumps in revenue here. Big jumps in revenue. 2.8 billion this year expected, 4.8 in 2027. Okay.
All right.
Let's go to Stock Analyzer tool, see if we can figure this thing out. Oh, wow, that free cash flow margin's huge, Mo.
Yeah.
So I'm going to do 5, 10, and 15%.
Okay.
Look at that ROIC, by the way. 35% in the last 5 years, 71% last year.
Wow.
They get really high returns on the money they invest in the business. Profit margin. Why is the free cash flow margin and the profit margin so different?
I know. Drastic.
Wow. 5. No. No, it'd actually be the normal number. Remember? Because they took off 1.1%. So it'd actually be, let's go 20. Let's go 18, 24, and 30.
Okay.
I'm going to do the same thing for free cash flow margin.
Mm-hmm.
Now, PE. PE's got a lot of high return on invested capital, high growth potential. So I'm willing to pay a premium for this company. So I'm going to go 15, 18, and 21.
Okay.
15, 18, and 21. But desired return, though, since it's a smaller company, you need a little bit more margin of safety here. Wouldn't you say?
Yes, absolutely.
So I'm going to go with 13, 16, and 19% because they could still get wiped out very easily being the small of a company.
If Etsy didn't exist in 5 years, I'd be like,
yeah, I'd be like, okay, not shocked.
no, not shocked at all.
Analyze button, a low of 46, a middle of 80, and a high price of 128. Guys, for me personally, I'm waiting. I want to buy it when it's like a really just like I'm actually going to add it to my watch list at $50. What was its low recently?
It's 52-week. Let's see here. Oh, $72.57.
Interesting.
All-time high, $307.75.
4x what it is today.
Yeah.
All right, now C Limited. C Limited is a company that now does Southeast Asia
Largest e-commerce company.
Yep. 43% gross margin. Here's the interesting part about C Limited. 1.67 times sales. Guys, this company isn't making money, is not making cash flow, has a lot of negatives. Does that mean it's not going to work? Not necessarily. But in order to find a value, you have to compare it to other companies that have pretty similar gross margin. For me, this company is it's like, I can't figure it out. I'm out. Because I look at this saying, it can't make money. Income statement. Yeah, it says $13 billion in revenue last year and still lost $1 billion. Look at all of our data for it. Money loss. It has lost money every single 12 months going back. Let's go to the annual. Did they even show a profit any year? Nope, nothing in there. Shares outstanding. Oh my gosh. Shares outstanding, guys. In 2014, they had 257 million. Now they have 558. They doubled up. I'm out.
Yeah.
I'm not even looking at it.
Yeah.
That's my opinion. Guys, if I'm wrong on C Limited, give me the reasons below why you actually like the company. Subscribe to the channel and 20% off at everythingmoney.com for our software. Thank you for your time.